Hey everybody, welcome. It's Pete. Welcome to today's episode of Stocks for Breakfast. Today is Wednesday, April 1st, 2020. Hope everybody is safe. I hope everybody is social distancing. Please be safe. We're going to get into the news in just a second. I normally don't focus on the news that much, but obviously it's very relevant right now. It's going to affect everything that we do. We got some really awesome comments today to review today. We had some comments about trade management, some comments about how to actually trade a trade, for lack of a better way of putting it. But I want to start out with something as soon as we jump into the charts in reference to timeframes and how everybody trades. We had a couple of good back and forths in yesterday's video about the best stock picks about trading certain stocks, and specifically talking about why would anybody be looking at cruise lines or any of those kind of stocks right now. And if you happen to catch that video, I was very specific in talking about accumulation. And I had mentioned that it was trading, RCL and CCL were trading double their average normal volume. Now, that double normal volume happens to be one of the scans that I run every single morning because I want to know, wow, did institutional money, did smart money all of a sudden wake up and start doing something in a stock? And you'd be surprised, actually, you'd be amazed at how many times you can catch what I call fuel or exhaustion. Fuel is when you get these large green body candlesticks coming out of a trading range that ignites a new move or a new trend. And exhaustion is after a large order flow type move, and you have ending in momentum, usually with very large candlesticks and a massive spike in volume. I call those exhaustion. Some other people might call them cleanup prints or capitulation. Pretty much the same thing, but I like exhaustion because in my mind, the same thing with fuel, it actually gets to the point where it's like the move is exhausted, it's over, all of that, remember order flow, all those actual orders are cleaned up and finished. So I want to get into and be respectful of the fact that we're talking to a lot of different people in these videos. Everybody's not day trading and everybody's not investing. And believe it or not, the majority of the people are, based on emails I'm getting and knowing the industry, I've been doing this for 20 years now, the majority of people have a full-time job and they're swing trading on the side. So they're looking to be actively involved in the market with a portion of their portfolio, and they're looking to hold from anywhere from 2 days to, could be 2 weeks, 2 months, but not necessarily everybody looking for a longer term investment. So I think it's kind of interesting how many different ways the market can be sliced. So I guess what I want to say is thank you so much for the comments. But if somebody happens to trade differently than you do, that doesn't make it wrong. It just means that they have a different time frame that they're looking to get a return on their capital. It could be cash flow versus somebody else who might just be looking for a stock that they want to hold for a few years, which many would call that an investment. The longer term trades that I discussed are normally what I call position trades. And that's more often than not from one quarter to the next, where stock will come out with earnings, and whatever that trend of earnings or guidance was for the next quarter, we can generally speaking, have that carry through to the next earnings report. So I'll look at day trades, swing trades, and position trades, but don't confuse an investment with what I mentioned in CCL, RCL yesterday, where I talked about accumulation. Accumulation came up from the fact that we had double average normal volume, and then we went into the charts and we started to notice that price action was going sideways with heavier volume. And generally speaking, after a down move, that means that the stock is being bought because there's massive volume, but it's no longer going down. So when I mention accumulation or distribution, those are not normally stocks that turn around as a swing trade. Those are a little bit longer term plays. So I guess what I'm saying is it's kind of fun and interesting to see the market through other traders or investors' perspective. So be respectful if somebody else trades a different time frame that you do, because we're talking and trying to help as many people as we can, but it's always in the context of what time frame you might be trading. I often use day trading examples because it accelerates how many stocks we can watch, but those same principles work on daily, weekly, and monthly charts as well, which actually kind of gets me into what I'm going to talk about now. We're actually going to get into how to set up trades based on probability using moving averages, which is something I normally don't do. I like to really get in there and work the charts because I think you can see what's going on in price action better without the filter of the charts and moving averages and then you can put them on there. But I think it's relevant because of a couple of really good questions we had yesterday from Jonathan. And Glenn actually had just asked me to take a look at trade management. So we're going to get into that now. We're going to shoot over to the charts. And by the way, if you find this video valuable, it would mean the world to me if you can click down and subscribe. And if you have any questions, absolutely leave a question. So we're going to hop on over to the charts. And first thing I want to talk about here is we're going to use Tesla as an example. But very simple moving averages. I have the 20, the 50, and the 200. So we have the 20, the 50, and the 200. And I'm using Tesla as an example because it brings up all of the different scenarios that I want to make sure that I talk about today. So in case you're kind of new to trading or something new to you, there's something called Dow theory in the markets. And it essentially says that there's always three different trends happening at the same time. And for the most part, you have the short-term day-to-day fluctuations. You have what's known as the intermediate term, which are the swings between quarters, and then you have the longer term, what I would call order flow, or the longer term trend. Now, in moving average terminology, bringing those Dow theory theories all the way into today, because that was created by Charles Dow probably 100 years ago. I don't know the exact date, but probably 100 years ago. We use the 20-period moving average. Could use a shorter time frame, but this is what I use. If you use a different one, that's fine, but this is the one that's worked for me. 20-period moving average to me is the day-to-day fluctuations and what I might call the momentum trend or the momentum order flow. Then you have the 50-period moving average, which is known as the intermediate trend in Dow theory, and the 200-period moving average, which is the long-term one. Now, the reason I'm bringing this up, number one, it's kind of cool to know, you want to be a student of the market. But generally speaking, and again, we trade for what generally happens, we trade for what probably happens. When the 20 is above the 50 and the 50 is above the 20 and rising, that's a key part because you can see the 20 is flat as the 50 is flat as a board here, right? When they're rising and in the right order, those are the best opportunities to be looking for longs, meaning buying opportunities, specifically when price action is also above the 20, as it was clearly here in Tesla. Now, what happens, the next thing to pay attention to is what happens when price action breaks the 20 and is trading between the 20 and the 50. Well, you are now working from, and hopefully you got this now, that you're working away from your A-plus trade and you start working lower where the probabilities of follow-through are decreasing. Now, let's take out of the equation the global situation, because this is a charting example and learning how to read the tape. It's not about what's going on in the news, because this happens over time and will always happen this way. When we're between the 20 and 50, that's an immediate way for you to say to yourself, it's not my perfect condition. I have to lower my risk profile. So in other words, if you want 1,000 shares, you're going to work that order a little bit more because the immediate buying pressure in this case is not as strong because we were able to pull back. So either the buying decreased or the selling increased. However, you're still above the intermediate trend. So you can actually still look for longs in this situation, but that requires building the position a little bit more conservatively and then knowing the 20 is going to be the next resistance level within that target. You can actually see it played out almost perfectly here despite the news, right? So again, above this level, you can be a little bit more aggressive with how long you hold the trades and maybe even how soon you enter. So in other words, breakouts versus waiting for pullbacks. In this particular situation here, you might wait for pullbacks and work your orders a little bit more, even though it's still a long. But then when we get all the way down here, you can see how beautifully that it actually held the 200 again, and you'd work orders if you even worked orders at all. Now, again, this is kind of the point that I'm bringing up that Jonathan had mentioned, looking at trading. Why would anybody be looking to trade the cruise lines right now when you could buy them 2 months from now? Absolutely true. But maybe some people don't want to miss out. Maybe they're working orders as prices move down. Maybe that's just something they want to put in their 401k because they think when everything is going to be fine down the line. So we all have different time frames, but I thought it was kind of interesting to start out by giving you a very clean framework for taking a look at stocks and how you could actually manage them just based on simple moving averages. But here's the key, and this is really the big thing that I want to get across. How you manage your trades should be dictated by the probability of follow-through. Because if you remember, everything that we do is based on probability. We don't know what's going to happen next. Nobody knows what's going to happen next. I don't care who you're watching on television. Nobody knows what's going to happen next. It's our job, though, to set up the probabilities, to stack the odds of what's probably going to happen next, but definitely follow our plan, which actually takes me into a trade in Apple that we're going to take a look at today, because it was a really good situation heading into the day yesterday. It was my favorite trade on the board, and exploded out of the gate and then pulled back and caught a couple of traders who kept looking for a pullback. And I'm going to just walk through the trade management of it really quickly. So let's pop over to the charts again. And we are going to pull up the daily chart of Apple, and then we're going to look at the intraday chart of Apple. So what I'm first going to do is I'm going to remove the moving averages just so we can look at pure price action. And if you remember yesterday coming into Apple, we had an inside day, which basically meant this candle was inside that one, this one was inside that one, and I was looking for a nice explosion to the upside that would last 3 to 5 days. And right out of the gate, we actually did get it. This was the opening price in Apple and the opening 15-minute window. So because now we were actually, let me just zoom that out a little bit, we were actually above the previous day's high and the prior one. So this is technically a breakout of that 2-day consolidation, which that was kind of exciting, right? So what ended up happening was, and I'm going to zoom down to the 5-minute chart because it's a lot easier to see. So when do you get in? This is a question. Once the stock, I'm going to actually answer Glenn's question here. Once the stock starts moving to what appears to be a good entry point, what do you do? How do you manage multiple trades? What is your actual entry point? We're going to touch on both of those things in a little thing. And how do you track multiple stocks? Glenn, I actually have a video from a couple of days ago. I'll actually post that. It's how to find the best stocks after the open. It really gets into that in a lot of detail. But for the point of what we're looking at in Apple, we want to set the tone that it was a consolidation for 2 days coming into the day. We were looking for a breakout. We weren't calling direction, but we happened to open up the previous day's high. So now we're in long mode. So now you have a choice. Do you wait for it to be above the open price or wait for the opening range breakout? Well, in this case here, because we were trading above the previous 2 days, you actually had a swing low here, which is one of my entry signals, and you had almost an inside candle, but this swing low. So above this candle, which also coincided above the opening price, was the entry here. That was the first entry. Now, if you want it to be a little bit more conservative, you have 1, 2, 3. These are the first 3 5-minute candles, which makes that the opening range. You could have waited a little bit more conservatively to get out of that opening 15-minute window, which would have made this the entry price. The problem with this entry price then is what's your stop loss? Your stop loss has to be all the way down here below the opening price, because you can't have a stop loss here because that's just not the right price. You have to put your stop at a place where if it gets hit, that's significant, but you can't put it within price action. Had a lot of people yesterday emailing me and messaging me telling me I was getting out and then it reversed. Well, you can't have your stop loss within the noise. You have to trade the right amount of share size, even if that means reducing it for the volatility. So if it gets hit, something changed, not just you flipped down 100 shares and it took you out of the position. And when I say 100 shares, I don't mean your 100 shares. I mean, you don't want to get taken out on a 100 share print just because it trades down there. It triggers your stop loss and then reverses and goes in the opposite direction. So bottom line is, this was a good entry here because we were above the prior 2 days high. We were looking for it and we kind of exploded, right? Not a good entry because of the entry itself, a good entry because of the setup. I want to make that clear. Good entries happens within good ideas. So here's what I really want to talk about now. You have this explosion to the upside, and let's just say for argument's sake you missed it. You pull back here, you get a bottoming candle, and you actually get what's an inside candle as well as a swing low. Is this a good entry? And I'll pause for effect. 100% it's a good entry. Everything at that particular moment said good entry. Exploded, coming out of a trading range, bounced to the upside, good trade, right? It doesn't make money. It's still a good trade. So managing a trade after you get in, there's only so many times where a trade could be valid where you're not making money. And the reason I'm bringing that up is this trade failed. Not only did it fail to test the previous high, this should have made a new high, all things being considered, right? Then you have another entry here, and you have another entry down here. Do you take this entry and this entry if that one did not follow through? No. You actually have a downtrend now intraday. So you have to be smart about which trades have the highest probability of follow through. So which trades at that point would have been the better trades to take in the afternoon? Well, the market was collapsing at that point because we actually rallied, failed, and we couldn't take out the multiple day high. So at that point, again, getting back to the point about why would anybody trade a certain stock, day traders are actively all day long looking for changes in the market. They're looking and trading back and forth for what it could be a 15-minute trend, it could be an hourly trend, which I'm gonna take a look at Micron in a second to show you what I mean. And they're validating their ideas on those micro time frames. Now, you might be somebody who holds a stock for months or years, but that doesn't make day trading wrong or somebody's strategy. So again, you can open your mind. Now, I also want to bring this up so that we're clear on it, because it's very important. I started out as a day trader in 2000. I started trading in '94, so I got a massive amount of strong opinions on this. Day trading can be challenging if you aren't disciplined. You need a rock solid plan for exactly when you're going to get in, when you're going to get out, and what constitutes a good trade. Most day traders struggle because they're chasing everything as opposed to looking for something specific. If you happen to lose money making good trades, that's a part of trading. You got to man up and put on your big boy overalls, big girl overalls. And if you happen to get slapped around, you got to pull your leverage back and say, I'm not getting a good read. And more often than not, that happens when the market reverses, like it did yesterday. You can still put on good trades that don't make money, but if you realize that something's wrong, you have to, like driving a car. You can't be driving 100. Let's not use 100. You can't be driving 55. All of a sudden, get into traffic and say, "Well, I still want to do 55." When the traffic is now stop and go, you got to pay attention. So, if you want to day trade and if you want to do that, you really need an absolute structure. For this is telling me I want to be long. This is telling me I want to be short. And by the way, that can change intraday for day traders. Now, I generally only trade in the direction that I would only swing trade. Generally, however, when I first started trading. And if you look up on the channel here, we have a scalping video. If you type scalping in there, super interesting of how we did it back in the day. We only traded 1-minute charts. So that's what I want to talk about as far as answering some questions that everybody had. But that's actually what ended up happening in the market yesterday. As the market got weak, the longs weren't as good of an opportunity. So kind of keep an eye on that. I just want to also bring up a couple of ideas that we were looking at. Some people had asked for some ideas. So I actually like VFC on the short side today, and you can see why. It actually did have a short covering rally. Remember, short covering rallies typically are not new buying. If it was new buying, it'd be going sideways and heading up. But yesterday, it actually was closed trading below the open the entire day. So I'm actually looking for this to short sell again below the previous low, and looking for 45 as the next trade. Same thing with JP Morgan, believe it or not. You don't want the financials to be pulling back, but I actually like this on the short side as well, especially because we took out the previous day's high and reversed. So that's usually a pretty strong indicator. So if we trade below this 2-day low, which you can actually see a little bit cleaner here actually, let me look at a 15-minute chart. We actually have 2-day support. So we're actually trade below that level and hold that level as resistance and get a short sale indicator. I'm going to be looking to short that as well. I want to finish up with Micron today because actually on the 60-minute chart, and we actually kind of mentioned this on the video yesterday in reference to the SPY, believe it or not. It's super important that you pay attention to, if you're watching your favorite stocks, is there actually something to do? Whether you're trading 1 stock, 5 stocks, or 10 stocks, you still need to pay attention to something like this. And you might not notice this on the daily charts, where Micron's basically at a trading range, give or take a couple of cents, now from the 24th of March. So we're talking about 1, 2, 3, 4, 5, 6, 7 days. Now, if you're a day trader, you could be looking at these micro trends and getting involved in there. But if you're looking for a good swing trade, that's the right price. There's nothing to do until the stock gets out of that window. So I thought that was kind of interesting to hopefully give you guys some opportunities to look at the markets in different ways. But probably the single biggest thing is respect the fact that people trade in different time frames. And if you have something you can add, absolutely leave a comment. If you want to build an argument for an idea, that really would help the community build on each other, because we all trade differently. But what doesn't change is how you choose to allocate risk in relation to the profit potential. So if you could use something as simple as paying attention to whether your stock's in a range and there's nothing to do, set alarms out of that range. Also using very simple moving averages to determine the odds of follow through and how strong a weaker stock is based on the order of the moving averages, where the price action is within those moving averages. And then, as I said, you can manage your trades differently based on whether it's above the 20 for long, whether it's above the 20, above the 50, or above the 200, and take it from there. So if you have any questions, absolutely leave a comment. Glenn, there's definitely another video. I'll see if I can post a link for that. I think I can. It's only a couple of videos back about how to manage stocks after the market opens. I give a lot of detail on that. If anybody else has any questions or something like to see covered, absolutely leave a comment. I appreciate you watching it. If you can click to subscribe, that would be awesome too. Have an awesome day, everybody, and please be safe.